Hello and welcome. I'm Manisha Gupta and you're watching Commodity Champions. The crude oil prices have hit a 9-month highs on expectations of additional supply cuts by major oil producers like Saudi Arabia and Russia. The prices have surged by 7% in the past 1 week alone and about 25% so far in this year. China's signs of economic recovery have also given a boost to the crude oil prices. Meanwhile, prices of gold and silver hit a 1-month highs but remained under pressure as the dollar index hopped back above 104. In the past 1 month, the gold and silver prices have plunged 0.5%, while silver is down nearly 5%. Same is the case with base metal prices also, which seem to be finding some footing right now with the kind of China stimulus measures that we have seen. To discuss the outlook for crude, precious metals and metals, I am now joined by Ole Hansen. He's head of commodity strategy at Saxo Bank. Ole, hi, thank you so much for joining us. And I'll start with the crude oil prices first, because that clearly seems to be making headline. We are looking at prices almost nudging $90 a barrel on the higher side. What's your sense on the kind of cuts that Saudi Arabia and Russia are talking about? I mean, that really seems to be the major reason that we've seen crude oil prices gain up by in whatever they've done in the last couple of months.
Indeed, Manisha, and it's almost been like with the stock market. We started the year with with some weak expectations due to recession fears, and the same thing happened in the oil market. But now we're basically back to 90, as you say, and most certainly the medicine is working if it's in terms of getting prices higher. For this, the cuts from Saudi Arabia and also recently from Russia is most certainly the main driver for the sentiment right now. Also, the demand from China is not showing any signs of peaking at this point, so demand outlook remains strong as well. So basically, we have a period here for the coming months where the market will remain tight, and that's attracting additional buying into the market. So clear level now at around that 90. Very key focus, I think. How will the global economy respond to prices moving above that level?
And I want to come back to prices a little later, but you mentioned about China, and India also was touted as a country where we will see demand growth continuing. But Indian import of Russian crude is the lowest in 7 months. We've seen 3 straight months of decline when it comes to imports overall as well. How would you read that?
Well, that's a good question. It does obviously indicate that first of all that the production is slowing and export is slowing, but also that there's other buyers that is bidding up for the oil that's coming out of Russia. So it's just part of the global competition for especially the kind of quality that is coming out of the Middle East and from Russia that is sought after right now, and that's also helping driving up prices of diesel and gasoline. But it does indicate that that export are slowing, and it is having an impact on the price action.
Well, how would you look at the prices then? I mean, 90, yes, but is it sustainable? Do you think more rhetoric or even action on ground could be coming in from OPEC and allies?
Well, right now, being negative on oil is like standing in front of an express train, because it seems like everyone is. We all see how this sentiment in the market just shifts from one extreme to another, and we're approaching an extreme bullishness in the market where it's difficult to find any reason for seeing it lower. But I think at the same time we have to keep in mind this tightness in the market is not because we run out of oil. It's political driven. It's politically motivated, and it's in order to achieve a higher price. And that obviously, that decision can be reversed for several reasons. One is if some of the other non-quota members of OPEC or producers outside, they take advantage of these higher prices to ramp up production, that will obviously reduce the market share that some of the countries have, like Saudi Arabia and Russia. And at the same time as well, it could potentially, well, what it does at the same time, it drives up the level of spare capacity, and rising spare capacity historically has not been good for the price, because it basically means that if we do have a crisis in terms of supply, then there is capacity available to meet that demand. So I'm lukewarm here. I see perhaps we pop above 90 in the short term, but I think we will see demand start to taper off as we head into the winter months, and that will also add some pressure on OPEC what to do next.
What's your sense also on the demand of products? Because while we've seen the US crude inventories continue to decline, the inventories of distillates and other products really seems to be building up.
They are, and that's also a sign that the refineries have been ramping up production, and we are heading into the so-called shoulder season of demand. We've had a very strong summer here with jet fuel demand rising very strongly. Diesel demand has been on the up as well, but they are building now, and we probably should see some changes there again over the coming months, because some of the refineries will go into maintenance. That should lower the demand for crude also. So we could potentially see crude stocks start to at least stabilize, while some of the product stocks may slow down or start to taper off. But overall, we are left in a situation right now where the market is tight, and we'll basically have to see whether demand into the winter months will taper off to the extent that we could see some stable prices.
Ole, you've said that 94 is a possibility on the higher side. I mean, are you at all thinking about a three-digit number here? If yes, until what time? What kind of sustainability? And where do you see supports now? I mean, should the consumers, the importing countries now let aside 60s and 70s in sense of prices?
Well, I think we found a floor now in the market down towards the 80 level.
Okay.
We've seen how action from producers has really created a line in the sand, you can say, at that area. So I still see the 80s as a sweet spot for oil prices, and the prices moving above 90. It adds all sorts of questions regarding the future direction of interest rates, because of inflation will start to pick up again from energy inputs, and if the central banks maintain rates for higher, that obviously will have a negative impact on growth, and with that also demand for fuels. So I think there is a balancing act here that yes, OPEC would like to have higher prices. They see peak demand within a few years, and obviously they want to optimize their revenue at this point in time. But at the same time, there's also a certain limit to how much the global economy can take when we are in a I would say not a recession, but at least in a period where we're seeing weaker growth in some of the major consuming countries.
And that clearly has had an impact on the metal prices as well. But here as well, Ole, would you say that we are near to bottom, because we haven't seen newer lower lows come in for many of these industrial metals, whether it's steel, iron ore. Iron ore actually seems to be doing quite well, by the way, but copper, zinc, aluminum also seem to be holding around their levels.
Yes, and I think that's very interesting because it's happening at a time where we are talking about China not struggling to find a gear. We're talking about recession worries in Europe and a slowdown in the US in the coming months. But I think also we have to remember what's been going on for the past 6 to 9 months. Industries and companies, they have all been worried about recession, so they've been cutting back their inventories. They've been scaling down their stock levels. So we had this period of destocking. And I think we're starting to see signs that is starting to reverse. So basically, even though consumers may not start to buy more goods, the producers are running low on stocks, and they have to be rebuilt. So I think that's providing some underlying demand. Copper prices are still the only industrial metal which is up on year on year, and again that's really due to the green transformation, where the demand for that transition has continued to increase and will continue to increase in the coming months and years. And that's why the long-term prospect, I would say, for copper remains very favorable.
So what's an upside that you would see for many of these metals, including copper?
Come again, sorry?
What kind of an upside are you anticipating from here on? I mean, would you say 4, 5, 10% before we end the year?
I think that's a 5 to 10% is probably a little bit on the high side, because we're still seeing a slowdown into the fourth quarter in the US. Europe is not doing terribly well, especially Germany. So it will really have to depend on the green transformation, and I think that will not see any major change there. But at the same time, we have to keep an eye on China, because right now the biggest correlation to copper is actually the Chinese renminbi. And we've seen some weakness there recently, which helped drive down copper prices. Over the past months, they stepped in to support the currency. If we do see additional renminbi strengths in the coming weeks, then obviously that would lay the foundation for a push higher in copper. But I think we're probably if we can finish the year 5% higher from here, then I think that would be quite a good result.
All right. I also want to talk about the other industrial commodities which are agricultural in nature. So with the crude oil prices rising, we've seen rubber prices gain up. There's support coming in there. Ethanol prices globally have been up. Sugar is trading at a one-month highs as well. So while there is a correlation from crude with many of these industrial commodities as well, how are you reading? And add to that the fact that this is an El Nino year. We have seen weather concerns in major producing countries.
Yes, and that's probably the biggest worry that we have right now, that the El Nino impact will be felt harder over the coming months. So we already now seen wheat production in Australia being revised lower. That could potentially be revised even lower. So even though we're coming out of what looks like a good season once again, crop season in North and South America, we're still not out of the woods on that front, and we are also seeing how rice prices has been moving higher. So for now, wheat is behaving well. Rice price is not, but overall, it's the cost to the consumer over the coming months, unfortunately, looks like if anything, is going to be higher.
A final question then, and this is about rice that you mentioned, but we've seen cotton prices continue to jump up as well. Cocoa is up, coffee not so much. Coffee clearly has been very volatile. So anything in agro commodities that you would particularly be concerned about going forward as in sense of price increase?
Well, really only the major staples. I mean, we can to a certain extent live without cocoa and coffee, but we cannot live without rice, wheat, and some of the main staples. So this is really where the focus is as well. We also seen something like orange juice futures hit record highs with a very decimated crop in the U.S. But again, it's something we can manage without. But it will be the main crops that we will keep a close eye on. Wheat looks okay for now. Rice is obviously a bit of a concern.
Clearly, rice has been a concern, and India, remember, has banned many of its varieties, the non-basmati ones, and there's a minimum export price as well on basmati here. So various measures, steps being taken by governments there. Ole, as always, thank you so much for joining today at CNBC TV18 and sharing your views on all of those commodities there. With that, let's go for a short break, but stay tuned. On the other side as well, we will continue to talk about precious metals and various other commodities. Welcome back. You're watching Commodity Champions. And before we went into break, we were discussing the outlook for crude and precious metals. To get in another perspective, we are now joined by Jonathan Barratt, who's CIO at Probis Securities. Jonathan, hi. Thank you so much for joining us. And the crude oil prices, the past 1 week has been quite strong. And as Ole was telling us, that 90 and 94 is a possibility as well. What's your sense with what the dollar index is doing? How is the rest of the year looking like?
Yeah, Manisha, look, it has been relatively bid most of the time, and I think that to me sort of bodes for it to actually go high, which is a bit of a concern for India. Look, I think the main reasons, there are two main reasons. I think we've got OPEC Plus agreeing to maintain their output cuts. We've also got Russia there also sort of saying that, okay, well, they're going to do less exports as well. So we have that supply tightness. Also ahead of that, we're coming into the hurricane season, and I think if you put in some restrictions there, then it is an issue. Also, you've got inventory draws in the States, which have been a bit larger than normal. So all this is creating this supply tightness that is just keeping the market bid. And obviously, US 90 is a big level. Let's see what happens.
Well, absolutely. And with the measures that China has been taking, how is the demand side looking like now?
Look, I think that's quite possible. The interesting thing about the Chinese and the Chinese stimulus, because that's what we're actually talking about. If you remember, the 2007-2008 stimulus program was absolutely huge, $586 billion. This time around, it's a lot different. I find that the policy is just on the edges. It's really nothing really hardcore yet. When you look at the tools that the PBOC have, they have quite a lot of tools still open to them. So I think it's more of a gentle approach. But as we've seen in other commodities like iron ore, for instance, we've seen it go better bid. So I think if you do see China sort of starting to lift its game in terms of its stimulus, then that's really going to sort of put a bit of a shift in the demand for crude oil. And let's look at it. If you just see domestic travel in China pick up by 15 to 20%, you're going to see a significant draw on fuel, and that's certainly going to support prices. So the Chinese, depending on how hard and fast they go on stimulus, I think was also a major factor in seeing crude oil prices break through US 90, and I think in the next quarter can often head up to 100 plus.
All right, so a three-digit in crude oil prices in the next quarter is a possibility. How would you also look at the dollar index? We've been seeing it consolidate around 104. Are the markets taking cues from that? What's your forward-looking trajectory here?
Yeah, I think when I look at the dollar index, I sort of get concerned that, when you look at US policy, although we haven't got a weak dollar policy there, I think that's something which I think the US would sort of look at, because obviously that stimulates their exports as a major provider, obviously, of crude. But when you look at the dollar trade and whether or not it sort of says dollar strong, commodities weak, or dollar weak, commodities strong, I think that will add to the flavour of seeing sort of crude oil, and for that matter some of the other commodities, head a little bit higher. There's sort of an engulfing story that commodities, given where China is, given where we are, and given there is some supply tightness already inherent in some commodities, the weaker dollar will just give it a bit more of a nudge.
How would you also look at the metal prices right now? It has a direct impact of what China does, what the dollar index does, and with China coming out with so many stimulus measures, would you say that a bottom has been created?
Look, I think we are, and I think whilst we've got the overhanging property issue in China, and remember, that's not going to go away very quickly. But whilst we've got that particular sector, I think, is going to be weighed down. I don't see that price getting or metal prices being consistently bid like oil. I think oil is in its own little class. But I do think there is that underlying feeling in the market that base metal prices will pick up once we get that stimulus program sort of really starting to gain momentum in China. Remember, we still have issues in terms of some metals where there are supply tightness, and one of that is copper, obviously, and we're keeping that well and truly on the radar, because we can see copper from here trade probably about 15 to 20% higher once we get that momentum about economies starting to recover. And to add to that, we've got China starting to recover. And I think also generally when the market's going to start to turn in terms of interest rates from that hawkish to dovish tone, then a lot of people are going to start to say, well, interest rates, they've reached their top around the Western economies, and as a result of that, that should open up the flow to more demand. So obviously 3 to 6 months, but you know what traders are like, they try and get ahead of the game. So if they start to see that, that could also underpin some reasonably good movers in some of the base metal markets.
You already spoke about copper, but where do you think the fundamentals are in sense stronger? What about steel, iron ore? Because these metals also seem to be doing quite well.
I think iron ore is quite interesting because I'll lead for that into the steel. But when I look at iron ore prices, really, we didn't think they'd be up around this 117 level. It is obviously tough resistance here. I think there is a little play at the moment that is supporting the iron ore price, and that has more to do with some domestic developments in terms of output quotas in China. And that's sort of coming in, obviously, as we head into the winter months. And I think the steel producers are just getting ahead of the market. But it sort of does tell us that if you have got a shortness or tightness in supply, that some of these commodity markets could really have a move to the top side. And iron ore is that one such, because I didn't think it'd get up to this level. I was sort of looking around sub 100 a dry ton for iron ore, but hey, we're at 117, so I'm still trying to work out whether it's got the impetus to really push through onwards up to 120. Hopefully it won't happen too soon.
All right. So while the other metals have been gaining, the industrial commodities have been surging as well. So rubber is up 6% in last 1 week. We've seen edible oil prices go up. Sugar is at a 1-month highs. Would you say that this upside that we're seeing in commodities as a sector is across board?
Well, look, I think that it is interesting, and keep an eye also on the CRB index. When I do look at it and look at the Baltic Dry freight index as well, there is this groundswell where people are saying, well, are the economies really contracting, or are they ready for another spurt to the top side? And I think the measure will be in really whether or not the slow growth or slowness in the economies become more apparent due to the recent bout of hawkish and tightness in monetary policy. or whether we're saying, well, okay, that's it. So really, it's sort of the jury's out as to saying, well, we've got potential to go in recession and everything goes lower, or it's saying, well, hey, that's over now and we're going to into a dovish picture, so therefore things should be bullish. So, but I think the jury's still out as to which side, but I do think you're dead right. Some of those commodities are getting a little bit better bid, I think, on this more optimism which might start to creep through the market.
Oh, absolutely. But the optimism is something that we see missing when it comes to precious metals. I mean, we did see gold and silver prices gain up quite strongly in the previous week, but that hasn't been able to sustain really.
Yeah, look, I think when I go look at gold, and I've always been a bull for gold, but that's starting to tarnish. I get a sense that it'll still have that lift with the US dollar and weakness. But when we don't have any of those real finders, those inflationary issues and all those starting to come, and we know the cost of holding gold's a lot more, I think we've got a major top around that 2,000 or 1,970, and I wouldn't think it would either be steady, but at my mind at the present time, I would be selling into any rally because I don't really see yet there's a reason to actually buy it other than a major macro concern.
And that's not something that we're looking at right now in the international market. So if you're selling gold right now, what levels are you looking at on the downside?
Yeah, if you look at the real ranges, for gold, anywhere up around that 1950, 1970 area, I think is a major top for it. I think 2000, it's on borrowed time. And I do think that around these levels, I think that you could really sell it because I think at the end of the day, I think it does come back to better prices to buy. And that could be sort of like sub 1900. That's more of a longer term type of call. But when the cost of carry is so high, you really have to question the need to hold a position that you're losing on interest rates every day.
Oh, well, absolutely that. And you said you're also selling silver. So what kind of targets are you looking onto that one?
I think similar to gold, you can really look at about a 15 to 20% correction would be my mind. And no, that's sort of certainly out there. But I generally think that whilst you've got this cost of carry, there's no real reason to buy it unless you start to move, that dovish tone starts to come lower and that cost of holding becomes less. But at these levels, it's not an attractive thing. And I think more it's better to take the profit rather than enter new positions.
Fair point that. So we're buying into crude, but copper prices will run up only if the metals get stimulus from China. But gold and silver is a definite sell coming in from Jonathan there. Jonathan, thank you so much as always for joining us at CNBC TV18. That's all the time that we have on Commodity Champions. Thank you for watching.